All right, let's get right into this explainer and decode a highly complex, honestly pretty chaotic standoff that's unfolding right now between the US Treasury and the global bond market. If you've been following the financial headlines lately, you already know there's this massive tug-of-war happening over long-term interest rates. Basically, the government is desperately trying to push them down, but investors, they are pushing right back. So today, we're going to break down exactly what just happened, the actual mechanics of how the government tried to intervene, and why a huge chunk of global investors are starting to ask some very, very uncomfortable questions.
But first things first, we've got to confront the sheer mind-boggling scale of the problem here. The United States national debt has officially surpassed $40 trillion. I mean, $40 trillion! It's a number so massive it's almost hard to wrap your head around, right? But it is the foundational reality for everything we're going to talk about today. Washington just keeps running these truly enormous fiscal deficits, which basically means the Treasury has to constantly issue more and more debt just to finance everyday government spending and roll over its old bills.
And here's where the immediate crisis really kicks in. Because just servicing that mountain of debt is now costing around $1 trillion in annual interest. That is $1 trillion every single year just to pay the interest, before even touching the principal. When you're carrying that kind of debt load, the interest rate you have to pay on it isn't just a spreadsheet number. It becomes a matter of absolute critical survival for the entire economy.
Okay, moving into Section 1, the $40 trillion debt problem and the stakes of the U.S. bond market.
So why is the bond market sending Washington such an uncomfortable message right now? Well, investors aren't demanding higher rates just for fun. They're looking at a perfect storm of economic risks. We've got unprecedented government borrowing, which means there's a massive supply of new Treasury debt just flooding the market. Add stubbornly elevated inflation to that mix, along with some serious geopolitical risks, including the economic fallout and the sheer cost of financing the war against Iran, and you literally have a recipe for severe market anxiety.
To put this into perspective, before the government even stepped in to try and fix things, these fundamental pressures had pushed the 30-year Treasury yield up above 5.2%, and the 10-year was creeping right up to 4.7%. Now remember, the Federal Reserve controls short-term rates, but these long-term yields, those are heavily influenced by the free market's expectations of future inflation and government stability. And at these levels, the market was loudly, clearly signaling its concern.
Which brings us to Section 2, Washington's market intervention, or what we can call Besson's $4 billion Band-Aid.
So to combat these surging rates, Treasury Secretary Scott Bessent announced a massive buyback plan. The idea was to double government purchases of longer-dated bonds to at least $4 billion per operation. The economic mechanics they were relying on here are actually pretty straightforward, kind of like a domino effect. First, the Treasury buys long-term bonds directly from the market. Second, this artificially increases the demand for those specific securities. Third, higher demand pushes bond prices up. And finally, because bond prices and yields always move in opposite directions, those pesky yields get forced back down. It's a very direct, active intervention in the open market.
And that sets up this incredible high-stakes tug-of-war. On one side, you have Washington, desperate for lower borrowing costs and willing to use its toolkit to forcefully push them down. On the flip side, you have global investors looking at the cold, hard fundamentals, the inflation, the $40 trillion in debt, the geopolitical conflicts, and they are demanding higher compensation for taking on all that risk. It's basically a classic showdown between artificial policy intervention and raw market fundamentals.
Let's see how that played out in Section 3, the bond market pushes back, a $4 billion reality check.
So, did the intervention work? Well, initially, sure, the announcement came out and yields actually fell a bit. Investors thought, okay, Washington is stepping up to stabilize things. But then, almost immediately, the bond market completely reversed course. Within about a day, long-term yields started climbing right back up. As the source perfectly summarizes it, investors essentially sent a defiant, super skeptical message back to the Treasury, basically saying, hey, nice try, but $4 billion isn't nearly enough to change the underlying fundamentals of a $40 trillion problem.
By the end of the week, the reality check was absolutely brutal. The yields hadn't just rebounded, they actually climbed even higher than they were before the intervention was even announced. The 30-year yield hit around 5.28%, and the 10-year settled near 4.74%. The market basically absorbed the Treasury's buyback, shrugged it off entirely, and demanded even higher rates anyway.
Naturally, Bessent responded by escalating his rhetoric.
He threatened that these buybacks could be increased even further, arguing that the high yields weren't actually justified by America's economic fundamentals, and he blamed the spike on temporary market overreactions to geopolitical headlines. But the source points out a pretty major, impartial reality check here. These buybacks, they really act as just a band-aid. Sure, they might grease the wheels and change the liquidity of those securities for a minute, but they absolutely do not eliminate the underlying debt, the massive deficits, or the inflation. Washington still has to issue enormous quantities of new debt no matter what.
Now let's look at the much bigger picture in Section 4, the threat to Fed independence and the danger of fiscal dominance.
To really grasp this, we need to understand a vital economic concept called fiscal dominance. This happens when a government becomes so desperate to finance its massive debt pile that those needs actually start to override independent economic data. So instead of the central bank, the Federal Reserve, setting interest rates strictly based on inflation and economic growth, they end up getting pressured to keep rates artificially low just so the government can afford to pay its own bills. It totally compromises the independence of the central bank.
And why is that independence such a big deal to global investors? Well, let's take a quick look back to 1951. Before then, especially during the wars, debt and monetary policy were heavily intertwined. But the 1951 Treasury-Fed Accord established a critical separation of powers. It made the Federal Reserve truly independent, and honestly, that independence is the exact reason global investors trust the US dollar enough to buy US securities. Today, these aggressive interventions by the Treasury are blurring those historic lines, and it is actively sounding alarm bells for the global market.
Then, you add a fascinating layer of political complexity. President Trump publicly distanced himself from the intervention, explicitly stating he did not direct Bessent's actions. Whatever the political reasoning is behind that statement, the financial takeaway is crystal clear. Bessent is taking an unusually activist role on his own. And this dynamic puts immense, glaring pressure on Federal Reserve Chair Kevin Warsh, especially right ahead of his critical appearances at places like Jackson Hole, where global markets are going to be hanging on to his every single word about the Fed's next move.
Let's bring this down to earth for a second. In Section 5, the dangerous feedback loop and why this cycle is hard to break.
The source details what we can essentially call the debt doom loop, and it is vital we walk through this because it's a vicious cycle. Step 1, investors demand higher yields. Step 2, because those rates are higher, the government's interest payments absolutely skyrocket. Step 3, those massive interest payments make the national deficit grow even larger. Step 4, a larger deficit means the Treasury is forced to issue even more debt to cover the shortfall. And Step 5, faced with a flood of even more debt, investors demand even higher yields as compensation for all that extra risk. It accelerates, and it becomes incredibly difficult to break.
So why should we care? Because the crucial takeaway here is that this is absolutely not just Wall Street noise or Washington drama. The bond market directly dictates the cost of capital throughout the entire American economy. When those 10-year and 30-year yields stay stubbornly high, it translates directly to higher consumer mortgage rates for anyone trying to buy a house. It means increased corporate borrowing costs, it puts massive strain on commercial real estate, and it puts downward pressure on the stock market. It literally touches every single corner of the economy.
And we can actually see this market anxiety playing out in real time across other asset classes. As the Treasury did this intervention, the US dollar notably weakened. That reflects growing concerns about the debt, about inflation, and about future purchasing power. Meanwhile, alternative, scarce assets like gold and Bitcoin, they rallied super strongly. That tells us investors aren't just viewing this as a quick, technical liquidity fix, they're actively seeking safe havens to protect their wealth from what looks a lot like a structural debt crisis.
Finally, let's wrap up with Section 6. What to watch next, proving control to the world.
The source outlines 3 major things we need to watch really closely over the coming weeks. First up, does the Treasury actually increase its bond purchases beyond that $4 billion mark? Second, can the administration produce a genuinely credible plan for reducing the federal deficit? The source notes some really deep market skepticism here, pointing out that a credible plan is highly unlikely while simultaneously trying to finance major geopolitical policies in the Middle East. And third, what exactly is Fed Chair Kevin Warsh going to signal about rate cuts amidst all this intense pressure? Ultimately, this entire $40 trillion standoff boils down to this one provocative question that the global bond market is basically daring Washington to answer. It isn't just about a $4 billion market intervention. It is entirely about faith in the system. Right now, the market is looking at Washington and saying, "Prove it. We don't believe you." So the real question is, how long can the government fight the global market before something entirely breaks? Thank you so much for diving into this explainer with me, and we'll see you on the next one.